Imagine this. You're at a dinner party, you know, the usual scene. Good food, drinks are flowing, and there's always that one person, let's call him Uncle Bob, who holds court at the end of the table.
Oh, I know Uncle Bob. We all know an Uncle Bob.
Exactly. And he's swirling his drink, looking incredibly pleased with himself, and he just announces to the whole room, I put my money in this mutual fund last year, and I made a 12% return.
The classic dinner party flex. The big absolute number drop.
It is. And, everyone around the table nods politely. You're thinking, wow, 12%, that sounds fantastic. I mean, it's double what a savings account gives you. It's beating inflation.
Yeah.
Uncle Bob looks like a financial genius.
Mm-hmm. He's the man of the hour.
For a moment, yeah. But then you go home, you open up your laptop, and just out of curiosity, you check the financial news. And you realize that the broader market, the very index his fund was probably supposed to be tracking, actually returned 15% over that same period.
And suddenly, the champagne tastes a little flat, doesn't it? Uncle Dob's celebration feels incredibly premature.
Right. That 12% isn't a victory anymore. It's a failure. He actually lost out. He underperformed what he could have made by just, buying a simple index fund and taking a nap for a year.
And that right there is the fundamental trap of investing based on raw numbers alone. We are just wired to love these big, simple, absolute numbers. But in the world of finance, an absolute number in a vacuum is, well, it's meaningless. Context is everything.
Welcome back to the Deep Dive. Today we are tackling that exact problem. We are going to strip away the marketing gloss, the dinner party bragging, and get right into the engine room of how investment success is actually measured. We are looking at mutual fund scheme performance.
This is such a crucial topic. It's really the difference between thinking you're winning and actually winning. And for today's discussion, we're basing everything on Chapter 11 of the NISM series VA Mutual Fund Distributor Certification Examination, the November 2025 version, to be specific.
And this is really the gold standard for understanding the mechanics of the Indian mutual fund industry.
It absolutely is.
I have to say, when I first started looking through the source material for this, I was a little intimidated. It's full of these Greek letters, alpha, beta, and terms like tracking error and Sharpe ratio. It honestly reads a bit like a physics textbook at first glance.
It can definitely feel that way.
But the more I got into it, the more I realized this isn't just theory. This is the toolkit for detecting nonsense. It's how you tell if someone is genuinely good at their job or just lucky.
That's a very, very apt way to put it. Think of performance measurement as a report card. If your child comes home with a B+, that might seem good, but if you find out the class average was an A and, the exam was open book...
Suddenly that B+ tells a very different story.
A very different story. So we're here today to learn how to grade the fund managers correctly.
So our mission today is to move everyone, including ourselves, from just looking at that raw percentage return to really understanding what risk-adjusted returns and benchmarking actually mean. By the end of this deep dive, the goal is for you to be able to pick up a fun fact sheet, look at that fine print, and actually understand what all those tiny rows of numbers are telling you.
Precisely. It comes down to answering two fundamental questions. First, what did the fund actually beat? And second, how much risk did the manager take to beat it?
Okay, let's start with that first one because it seems foundational. What did we beat? And that brings us straight to the concept of the benchmark. Section 11.1 in the source text defines it as a predefined standard against which a scheme's performance is measured. But what does that look like in the real world?
In the simplest terms, think of a benchmark as a yardstick. It's the ruler you use to measure success. If you're a fund manager, you can't just operate in a vacuum and say, I made money. You need a standard, a point of comparison.
Okay, so it's the baseline.
It's the baseline. But the source material is very specific about what makes a credible benchmark. It's not just any random index you can pull out of a hat. The text lays out 3 key requirements.
What are they?
Okay, so first, it must be aligned with the investment objective of the fund. So if you're running a technology fund, you can't benchmark yourself against, say, a banking index. It makes no sense.
That would be like comparing a sprinter's 100-meter time to a marathon runner's time. They're just different races. Exactly.
Completely different races. The second requirement is that the benchmark must align with the fund's asset allocation pattern. So if your fund is, say, 60% equity and 40% debt, your benchmark needs to reflect that specific mix.
So you can't just pick a pure equity index in that case.
You can't. That would be misleading. And third, and this one is absolutely critical for trust, the benchmark must be calculated by an independent agency. We're talking about organizations like the stock exchanges themselves or major credit rating agencies. And it has to be published regularly for everyone to see.
Ah, so the fund manager can't just cook up their own benchmark in a spreadsheet to make themselves look good.
No, absolutely not. That independence is key. It prevents the students from writing their own answer key to the test.
That's a great way to put it. Now, this whole idea of benchmarks leads us directly to one of the biggest aha moments I had while reading section 11.2 of the text. It's this battle of the acronyms, PRI versus TII.
Oh, this is a huge one. This is a nuance that used to trip up a lot of investors, and frankly, it made a lot of fund managers look better than they were before the regulations tightened up.
Okay, so break it down for us. PRI and TII.
Sure, PRI stands for Price Return Index, and TRI stands for Total Return Index.
And for a long, long time, most funds in India were comparing their performance against the PRI. Is that right?
They were, yes.
Right.
And here's exactly why that was a problem. A Price Return Index, the PRI, only captures one thing: capital gains. It only tracks the movement in the stock prices of the companies that make up that index.
Okay, so if the Sensex goes from 60,000 to 66,000, the PRI captures that 10% gain.
Correct. But it completely 100% ignores dividends.
But wait a second, companies pay dividends all the time. If I own a stock, I get that money. So if a mutual fund owns that stock,
The mutual fund gets that money too. And this isn't trivial. In India, historically, the source text points out that the dividend yield on major indices has ranged from about 1.5% to 2.5% annually.
okay, I think I see where this is going.
Right. So imagine you're a mutual fund manager. You own all the stocks in the index. You're receiving all those dividends. That dividend cash gets added directly to your fund's net asset value. It's NAV. It boosts your performance.
So let me get this straight. As the fund manager, I'm collecting the share price growth plus the dividends. But I'm comparing myself to a benchmark, the PRI, that only shows the share price growth.
You've got it. You are effectively starting the race with a 1.5% to 2.5% head start every single year. It was a massive systemic, unfair advantage. It made fund managers look like geniuses because they were beating the benchmark simply by collecting dividends that the benchmark wasn't even counting.
That feels like a massive loophole. It's not skill, it's just accounting.
It absolutely was a loophole. And that's why SEBI, the regulator, stepped in. As of February 1st, 2018, it became mandatory. All mutual fund schemes must be benchmarked against the Total Return Index, the TRI.
And the TRI includes those dividends.
Yes. The TRI captures the capital gains plus all the dividends or interest payments, assuming they are immediately reinvested back into the index.
So now the comparison is finally apples to apples. The benchmark's performance includes the dividends, and the fund's performance includes the dividends.
Correct. It effectively raised the bar for every single fund manager in the country overnight. It made it optically harder for them to beat the benchmark, but it is infinitely more honest and transparent for you, the investor.
I want to clarify one thing that often confuses people, and it's something the notes touch on. What about the growth option of a mutual fund? As an investor, if I pick the growth option, I don't get a dividend check sent to my house. The money is reinvested. So why should my fund be compared to a total return index?
That's a fantastic question, and it's a very common point of confusion. Here's the key. Even in the growth option, where you, the unit holder, don't get the cash payout,
Right.
the fund itself still received that dividend from the company, whether it's Reliance or Infosys or whoever. The fund manager got that cash. And what did they do with it? They took that cash and used it to buy more shares within the portfolio.
Ah, so the total value of the fund's assets still went up because of that dividend.
Precisely. The value of your units, your NAV, still reflects that dividend income, even if you didn't see it in your bank account. Therefore, the benchmark absolutely must also include it to be a fair and accurate comparison.
Got it. So regardless of whether I, as an investor, take the cash as an income option or have it reinvested in a growth option, the fund earned it, so the yardstick must account for it. Simple as that.
Simple as that.
Okay, this is super clear. Now, let's move into our next segment. We've established what a benchmark is and why TRI is the fair standard. Now, let's talk about matching the ruler to the cloth. This is all about choosing the right benchmark for the right fund. Section 11.3 and 11.4 of the source material get into this.
This really goes back to that idea we mentioned earlier. You can't judge a fish by its ability to climb a tree. And in the same way, you absolutely cannot judge, say, a small cap fund by the performance of the Sensex.
Why not? The Sensex is the market, isn't it?
Well, it's a market index, but it represents the 30 largest, most stable companies in India. A small cap fund, by definition, is investing in tiny, volatile, high growth potential companies at the other end of the spectrum. Their performance characteristics are completely different.
Right, so if I have a large cap fund, I should be looking for a benchmark like the Nifty 50 or the Sensex. But if I have something much more specific, like a banking sector fund.
Then comparing it to the Nifty 50 is almost useless
How so?
because the Nifty 50 has pharma stocks, IT stocks, auto stocks, consumer goods. It has everything. Imagine a year where the banking sector as a whole crashes due to some policy change, but the IT and pharma sectors have a massive rally.
Oh,
Your banking fund will look absolutely terrible when compared against the Nifty 50, even if your fund manager did a brilliant job of minimizing the losses within the banking sector. They might have lost 5% when all their banking peers lost 15%. They were actually a great manager in that context.
But against the wrong benchmark, they look like a failure.
A total failure. This is why a banking fund must be compared to a banking index, like the BankX. An IT fund against an IT index. You have to compare like with like.
Now, the source material mentions a very specific regulation that came in October 2021. It's called the two-tiered benchmark structure. This sounds a bit technical, but it seems really important for standardizing all of this.
It is extremely important. SEBI, the regulator, realized that even with the TRI mandate, benchmarking was still getting a bit messy. Some fund houses might pick a slightly different benchmark for the same type of fund, making direct comparisons difficult.
So they created a new system to clean it up.
Exactly. They introduced this two-tier system, which is detailed in Section 11.6. It works like this. Tier 1 is the category benchmark. This is a standardized benchmark that reflects the broad SEBI category the fund falls into.
Give me an example.
Okay, so if your fund is categorized as a large cap fund, your Tier 1 benchmark is likely going to be the Nifty 100. Every single fund in the large cap category will use this as their primary benchmark.
Ah, so that creates a level playing field. Now I can look at all the large cap funds and see how they performed against the exact same yardstick.
That's the whole point of Tier 1. It's for standardization and easy comparison across a category.
Okay, so Tier 1 tells me how my fund did against the broad market it's supposed to be operating in. What on earth is Tier 2 then?
Tier 2 is the style or strategy benchmark. This is a secondary benchmark, and it's often optional, but it's incredibly useful for funds that have a very specific investment strategy.
Strategy. Like what?
Let's say you run a large cap value fund. Your category is large cap, so your Tier 1 benchmark is the Nifty 100. But your specific style is value investing. So your Tier 2 benchmark might be a specific index like the Nifty 500 Value 50 index.
I see. So the second benchmark measures you against your specific promise. Are you actually good at value investing, not just at being in the large cap space?
You've nailed it. It adds another layer of accountability. It helps the investor see if the manager is truly sticking to their stated style.
And that makes a lot of sense. It stops the so-called value manager from just drifting over and buying popular growth stocks just to chase returns because that Tier 2 value benchmark will catch them out.
Precisely. It keeps them honest about their strategy.
Now, what about for non-equity funds? Benchmarking stocks versus a stock index seems relatively straightforward.
Yeah.
But debt funds seem more complex.
They are, and the same principle of like for like applies, just with different variables. In debt, you're not just looking at company size. You have to match the maturity and the credit profile of the bonds.
Maturity being how long until the bond is repaid.
Correct. So, as Section 11.5 in the text notes, a liquid fund, which invests in very, very short-term money market instruments, things that mature in a few days or weeks, will use a benchmark like the CRISIL Liquid Fund Index.
And you wouldn't compare that to, say, a gilt fund that holds 10-year government bonds.
Absolutely not. The risk profiles and return expectations are on different planets. A gilt fund would be benchmarked against a government security index with a similar duration. The key is always to match the fund's portfolio characteristics.
Okay, and what about hybrid funds? These are the funds that are designed to mix equity and debt. Do they just pick one benchmark and hope for the best?
No, that wouldn't be fair to anyone. They use what the industry calls synthetic indices, or you might hear them called blended benchmarks.
A synthetic index?
Yeah, it's actually quite clever. The benchmark is literally a mathematical calculation that mirrors the fund's mandate. So if a fund's official mandate is to hold 65% in equity and 35% in debt,
let me guess. The benchmark is 65% of the Sensex's return plus 35% of a bond index's return.
that's exactly it. They create a custom-made blended yardstick that perfectly reflects the fund's intended asset allocation.
That is fascinating. So it's the only way to really isolate the manager's performance. You can see if they're adding value through their specific stock and bond selections, or if the returns are just a simple result of that 6-5-35 asset mix they were supposed to have.
It separates the asset allocation decision from the security selection skill. It's a much sharper tool for analysis.
All right, this is all making so much sense. We have established what we are beating, the benchmark. Now comes the part I'm really excited to get into. We're going to decode the so-called Greek alphabet of performance. This is where section 11.7 of the text on quantitative measures of fund manager performance comes in.
This is where we shift gears. We move from the question, did we make more money than the benchmark, to the much more interesting question, how skillful was the manager in the process?
Let's start with the trap we fell into in the intro with Uncle Bob, the simplest measure. Relative returns. This is just taking the scheme's return and subtracting the benchmark's return.
Right. It's simple arithmetic. Your fund made 15%. The benchmark made 12%. Your relative return is plus 3%. In industry speak, that's called outperformance.
And on the surface, that looks great. Who doesn't want an extra 3%? But the text is very clear that this is a flawed metric on its own because it completely ignores risk. Can you explain why that plus 3% might actually be a bad thing?
I can. Let's use an analogy. Imagine you have two drivers, and you tell them both to get you to the airport. Driver A gets you to the destination in 20 minutes by driving smoothly, following the speed limit, and obeying all the traffic laws.
Okay, a safe and reliable driver.
Driver B gets you there in 15 minutes, 5 minutes faster.
So a higher return.
A higher return. But to do it, he ran 3 red lights, drove on the sidewalk for a block, and nearly hit a bus. Who was the better driver?
Okay, I see exactly where you're going. Driver B was faster, sure, but the risk of a catastrophic crash was enormous. I'd much rather ride with driver A.
Of course you would. And it's the same in investing. A fund manager can take absolutely reckless risks, buying highly volatile, junk-quality stocks, for example, and they might get lucky for a year and beat the benchmark by 3%. But if the market turns, that same portfolio might crash twice as hard as everything else. We need to measure if the return was worth the risk taken.
And this brings us to the first major metric for doing just that. The Sharpe ratio. I see this on literally every single fact sheet, but I have to admit I've usually just glossed over it. Section 11.7.1 gives us the formula, which looks a bit scary. Scheme return minus risk-free return, all divided by standard deviation.
Let's unpack that logic, because it's actually really elegant. Let's start with the top part of the fraction, the numerator. Scheme return minus risk-free return.
What's the risk-free return?
It's usually the return you'd get from a short-term government treasury bill. It's considered risk-free because the government is guaranteed to pay you back. Let's say that's 6% for the year.
Okay.
That 6% is basically free money from a risk perspective. You don't have to take any market risk to get it. So if your mutual fund gives you a 10% return, only 4% of that is actually extra return you earned for taking on the risk of the stock market. We call that the risk premium.
Okay, so I earned a 4% premium for being brave enough to invest in the fund instead of just buying a safe government bond.
Correct. Now let's look at the bottom part of the fraction, the denominator. Standard deviation. We've talked about this in previous deep dives. It's the classic measure of volatility or total risk.
Yep.
It tells you how much the fund's returns bounce up and down.
Right, a higher standard deviation means a bumpier ride.
A much bumpier ride. So if you put it all together, the Sharpe ratio is risk premium divided by total risk. It's asking a very simple question. For every single unit of risk you took, how much extra return did you get?
So it really is a bang-for-your-buck ratio, but specifically for risk.
That is the perfect way to describe it. A higher Sharpe ratio is always, always better. It means you're getting more return for the same amount of turbulence.
So if Fund A and Fund B both return 12%, but Fund A has a Sharpe ratio of 0.5 and Fund B has a Sharpe of 1.5.
Fund B is vastly superior. It means the manager of Fund B achieved that same 12% return with a much, much smoother and less risky journey. They were more efficient with the risk they took.
That is a complete game changer for evaluating funds. It's not just about the destination, it's about the journey. But there's a key constraint mentioned in the text. You can only compare Sharpe ratios within the same category of funds, is that right?
Yes, that's a critical point. You cannot compare the Sharpe ratio of a debt fund to an equity fund. It's meaningless.
Why is that?
Because debt funds, by their very nature, have very low volatility, very low standard deviation. Equity funds are much more volatile. The math just doesn't work out for a cross-category comparison. So stick to comparing large cap to large cap, small cap to small cap.
Got it. Okay, next up in our Greek alphabet tour is the Trainer ratio, covered in section 11.7.2. At first glance, it looks almost identical to the Sharpe ratio. The numerator is the same, risk premium, but the denominator is different. Instead of dividing by standard deviation, it divides by beta. What's the difference, and why does it matter?
This is a subtle but important distinction. It's all about how you define risk. The Sharpe ratio uses standard deviation, which measures total risk.
Total risk meaning everything.
Everything. It includes risks from a broad market crash, risks specific to a certain industry, and even risks specific to a single company, like a factory fire or a corporate scandal. It's the whole pie of risk.
Okay, so what does beta measure?
Beta only measures one slice of that pie. Systematic risk, also known as market risk. It measures how much a fund tends to move in relation to the overall market. So a beta of 1.0 means the fund moves in lockstep with the market. A beta of 1.2 means it's 20% more volatile than the market.
So Sharpe uses the whole pie of risk, and Trainer just uses the market-related slice. Why would you want to use the smaller slice?
Well, the Trainer ratio is based on a core concept in finance theory, which says that unsystematic risk, that company-specific risk, like the factory fire, can and should be diversified away by holding a lot of different stocks.
Right, if one of your 50 stocks has a scandal, it doesn't sink your whole portfolio.
Exactly. So the theory goes, a well-diversified portfolio shouldn't be penalized for that kind of risk because it's easily managed. Trainer, therefore, answers a slightly different question. It asks, how much excess return did you get for taking on the market risk that you cannot diversify away?
I see. So it's most useful for a fund that is already very well diversified.
Yes. The text suggests it's best applied to fully diversified equity portfolios to see how well the manager handled the one risk they couldn't avoid, the systematic risk of the market itself.
Okay, that clarifies the difference.
Okay.
Now let's talk about the undisputed celebrity of financial metrics, the one everyone loves to throw around, alpha. People are always talking about generating alpha, seeking alpha. What is it, really?
Alpha is the holy grail. If Sharpe and Trainer are about measuring the quality of the ride, alpha is about measuring the magic. It is considered the purest measure of a fund manager's skill.
Okay, high praise. How is it calculated?
To understand alpha, we have to go back to beta for a second. If the market goes up 10% and your fund has a beta of exactly 1.0, your fund should theoretically go up 10% just by existing. You didn't do anything special, you just rode the market wave.
That's the expected return based on the market's movement.
Exactly. Alpha is the return you generated over and above what the beta and the market's performance would predict. It's the unexplained excess return.
So if the market went up 10%, and based on my fund's risk profile, its beta, I should have made 10%, but I actually made 12%. That extra 2% is my alpha.
That extra 2% is your alpha. And the implication is that it didn't come from the market. It came from the manager's unique skill, their ability to pick the right winning stocks, and, just as importantly, avoid the big losers. That is positive alpha.
And what if you only made 8% when you're expected to make 10?
Then you have a negative alpha of 2%. And what that means is the manager's active decisions actually destroyed value. You would have been better off from a performance standpoint if they had just bought a simple index fund and done nothing.
That is a brutal, brutal report card. Negative alpha means you are literally paying fees for someone to lose you money relative to what the market gave for free.
Which is precisely why alpha is considered the true measure of stock picking ability. When you pay the higher management fees for an actively managed fund, what you are paying for, what you are hoping for, is alpha.
This is incredibly illuminating. Let's move on to our next segment, which is all about consistency and the mandatory disclosure. Because, look, getting a high alpha once could just be luck, but doing it year after year, that's skill. And this brings us to section 11.7.4 in the text, and a term I'd never focused on before. The information ratio?
Ah, yes, the information ratio. Now, what's fascinating about this one is that the text points out this is the only risk-adjusted performance measure that SEBI actually mandates that asset management companies disclose in their materials.
The only one. Not Sharpe, not Alpha, but this one. That makes it sound pretty important.
It is the regulator's favorite for a very good reason. The information ratio's unique job is to measure the consistency of the outperformance. It's not just about how much you beat the benchmark by, but how reliably you did it.
Okay, how does it do that? The formula looks like it incorporates the standard deviation of excess returns. Can you explain that in plain English?
I can. It's all about separating luck from skill. Imagine manager A. One month, he gets super lucky and beats the market by a wild 10%, but the next month he underperforms by 8%. His average might look okay, but his performance is all over the place. It's erratic.
Okay, very volatile outperformance.
Exactly. The standard deviation of his excess returns is very high. His information ratio will therefore be low. Now imagine manager B. She beats the market by a steady, reliable 1% every single month. No huge wins, but no big luxes relative to the index either.
She's the tortoise, not the hare.
She's the tortoise. And because her outperformance is so consistent, her standard deviation of excess returns is very low. Therefore, her information ratio will be high. SEBI wants you, the investor, to know if the manager's performance is reliable and repeatable, or if it's just a result of a few lucky wild bets. A high information ratio suggests skill over luck.
That's a fantastic distinction. So while alpha tells me if you added value, the information ratio tells me how consistently you added that value.
Perfectly said.
We also need to talk about another key term here, tracking error, which is in section 11.8.
Right. Tracking error sounds technical, but the concept is simple. It is the standard deviation of the difference between the fund's return and the index's return. In simple terms, it measures how much a fund's performance deviates from its benchmark.
And how we interpret that number depends entirely on the type of fund.
Completely. Let's take passive funds first. So, index funds, or ETFs. For them, the entire goal is to perfectly mimic the index. Therefore, the goal for tracking error is zero.
Or as close to zero as possible.
As humanly close to zero as possible. If the Nifty 50 goes up 10% and your Nifty 50 index fund only goes up 9.8%, that 0.2% difference is tracking error. And in this context, it's bad. It represents an inefficiency.
But what about for active funds, the ones that are trying to beat the market?
For active funds, it's the opposite. You expect them to have a significant tracking error. If an active fund has a tracking error of zero, it means it's just a closet index fund. It's hugging the benchmark so closely that it has no chance of outperforming. You're paying active fees for passive management.
So a high tracking error is a sign that the manager is actually making active bets and deviating from the index.
Yes. In the modern context, it's used to measure the consistency of that active management. But, and this is a huge but, that high tracking error must be justified by high returns, specifically by high alpha. If you have a high tracking error and low or negative alpha, that's the worst of all worlds.
So you're just being different for the sake of being different, and you're failing at it. You're taking risks for no reward.
You're taking risks for no reward. It's a recipe for disaster.
Okay, so let's move into our final segment. Where to find the truth, disclosures, and tools. We've learned about all these incredible concepts, but it's useless if we don't know where to go to find them.
Absolutely. This is the practical application part. And section 11.9 in the source material points us to the key documents. First up is the SID, or the Scheme Information Document.
And that is
the big one. That is the big one. It's the primary legal document for the fund. It's updated at least yearly. It's dense. It's full of legal language. But it is the ultimate source of truth for the fund's objectives, strategies, and benchmark policies.
And what about the one most people actually read? The fact sheet.
Right, a monthly fact sheet. The text notes that this isn't a mandatory regulatory document in the same way the SID is, but it has become universal market practice. It's the fund's monthly report card to its investors.
And what can we find in there?
All the key data points. The latest NAV, the total assets under management, or AUM, the total expense ratio, TER, a snapshot of the top portfolio holdings, and yes, usually a table with all the Greek ratios we've just discussed, Sharpe, beta, alpha, and so on.
And it also features that little graphic, the riskometer, right?
Yes, that speedometer-looking graphic with the 6 levels of risk from low to very high. It's a simple visual guide to the fund's overall risk level.
The text also mentions the AMFI website as a central hub for data.
It is. The Association of Mutual Funds in India, or AMFI, provides a wealth of industry-level data. You can actually go there and download Excel sheets with the performance data for basically all funds, which allows for really powerful side-by-side comparisons.
Now, when we're looking at that performance data, the text brings up a really important concept in section 12.3, rolling returns. Why are these considered superior to the standard point-to-point returns we always see?
Because point-to-point returns, like the last one-year return you see in advertisements, can be incredibly misleading. Their value depends entirely on the start and end dates you choose.
How so?
Well, if your one-year period happens to start at the exact bottom of a market crash and end a year later, the return is going to look spectacular. Conversely, if you start at a market peak, the return might look terrible. It's very sensitive to timing luck.
So what do rolling returns do differently?
Rolling returns smooth out that noise. Instead of one single one-year period, it calculates the average of many overlapping periods. For example, it would calculate the return from Jan 1st to December 31st, then from Jan 2nd to Jan 1st of the next year, and so on, for every single day over, say, the last 5 years. It gives you a much more robust and honest picture of the fund's structural performance, independent of when you happen to invest.
That makes so much sense. It shows you the typical experience of an investor over time, not just one lucky or unlucky snapshot. What about another metric I see in fact sheets? Portfolio turnover ratio.
Turnover. This measures how often the fund manager is buying and selling securities within the portfolio. A turnover ratio of 100% means that, on average, the manager has replaced the entire portfolio over the last year.
And a high turnover isn't necessarily bad, but it comes at a cost, right?
It comes at a significant cost. Every time the manager buys or sells a stock, there are brokerage fees and other transaction costs, which are paid out of the fund's assets, your money. So you have to ask the question, is this high level of activity, this high cost, actually justified by higher returns? If a manager is churning the portfolio constantly but not generating any alpha, they're just burning your money on fees for no benefit.
There's another check and balance. Is the activity productive? Finally, let's just quickly touch on the standardized disclosures that SEBI mandates.
Right. To make comparisons easier, SEBI requires all funds to show their performance for specific standardized time periods: 1 year, 3 years, 5 years, and since inception.
So you can't just show your best-looking time period.
No cherry picking allowed. And crucially, for each of those periods, they must show the returns for 3 things side by side: the scheme itself, its Tier 1 benchmark, and an additional benchmark, which is usually a broad market index like the Nifty 50 or Sensex.
So you can't hide behind a weak or obscure benchmark. You're always compared against the big leagues as well.
Exactly. It's all about providing multiple points of comparison for maximum transparency.
Okay, let's try and bring this all together in our outro. What a journey.
Yeah.
We started with Uncle Bob's simple 12% return, and now we've moved to a place where we're asking a whole different set of questions.
A much smarter set of questions. We move from looking at a single, isolated percentage to asking, okay, but what was the benchmark? Was it a TRI benchmark? What is the alpha? And is the Sharpe ratio higher than its peers?
Exactly. We've armed ourselves, and hopefully you, the listener, with the tools to look past the marketing headlines and the dinner party bragging.
We've given you the toolkit to be a financial detective.
So, I think the big practical takeaway here is this. The next time you see a magazine cover or a website with a list of top-performing funds, take a moment. Dig one level deeper. Check if that list is based purely on raw returns or if it considers risk-adjusted consistency. The fund with the highest return might just be the one that took the highest and maybe even the most foolish risks.
And to leave you with a final provocative thought to mull over, the source material is very clear that all of these quantitative measures, Sharpe, alpha, all of them, are based on historical performance. They tell you what has happened.
Right. The past.
So here's the question. If a fund manager has a fantastic high alpha and a brilliant Sharpe ratio for the last 5 years, does that actually predict that they will do well in the next year? Or is it just like trying to drive a car by looking only in the rearview mirror?
The classic disclaimer. Past performance may not be sustained in the future.
It's there for a reason. Is manager skill a permanent, repeatable trait? Or is the market just a great equalizer that humbles everyone eventually? That's the billion-dollar question.
That is something for everyone to think about. For now, our challenge to you is this. Go find the latest fact sheet for a fund you own or are interested in and try to find the information ratio. See what story it tells you. Thanks for joining us on this deep dive.
Thanks, everyone.